Hello kings and queens of forex trading, welcome back to Babypips course 6 of 11 high school. We have completed grade 9 trading divergences, grade 10 market environment, grade 11 trading breakouts and fake outs, grade 12 fundamental analysis, grade 13 currency crosses, and now we're about to round up with course 6 by discussing multiple time frame analysis. I am so excited, and so let's dive right into this and check out the subtopics we have under multiple time frame analysis. The first one is trading multiple time frames in forex. Secondly, what time frames should I trade? What time frame is better for trading? Why you should look at multiple time frames when trading forex, how to use multiple time frame analysis to find better entries and exit points, and then trading with 3 time frames, and lastly, summary, multiple time frame analysis. I can tell you how happy I am. It's been a lot of work, but we're making progress gradually. So let's dive right into the very first subtopic that says trading multiple time frames in forex. But wait, before we begin, please somebody roll the intro. So what is multiple time frame? You might be like, what? Multiple time frame analysis? Oh my goodness, I don't want this. Hey buddy, chillax, okay? Relax. You don't need to put on or get some seniorities right now. You got that in grade 12, okay? So multiple time frame analysis is simply the process of looking at the same pair and the same price but on different time frames, okay? Now you know we have different time frames from the daily, in fact from the monthly, weekly, daily, 4 hour, 1 hour, the 15 minutes, the 5 minutes, even the 1 minute, okay? So here is the time frames we have, okay? There is even 1 second, 5 seconds, 15, 30 seconds, oh my goodness, of time frames analysis. Now on the 4 hour chart, when you look at the 4 hour chart, this is how price might be moving. You see, smooth right to the top, okay, coming down as well. Now if you look at that same price action on a 60-minute chart, that's 1 hour, this is how it looks like, jigsaw, okay, but still in the same direction, up and down. Now if you look at it on the 15-minute chart, it's the same thing, the same direction, but it has lots of noise on the 15-minute chart. What we're learning here is that time frame usage differs from trader to trader. Some traders are comfortable using the weekly only, others are not, others just want 15 minutes, others just want the 1 hour, okay? So it depends on that time frame which you are comfortable in trading. Some traders get confused when they look at the 4 hour time frame and they see a signal and they say to themselves, I saw price going down in the 4 hour, how come it's going up in the 1 hour? So what should you do? Are you supposed to stick to one time frame, take a signal and completely ignore the rest time frame, or flip a coin to decide whether or not you should buy or sell? Both of those two options are wrong. So what are the benefits of looking at multiple time frames? They give you different perspectives and views of a currency pair. They enable you to spot upcoming support or resistance area. They enable you to spot trend changes earlier. They help you to enter or exit a trend as early as possible. They help to confirm the trend change in higher time frame. They also allow you to know what other market participants are thinking. They enable you to see the small picture, medium picture, and the big picture. Interestingly, Babypips is not going to let us graduate from this course without understanding how to use time frames, and they are not going to let us go without teaching us a specific time frame that fits each and every individual and what is best for you to work with, okay? So let's move to the next lesson that talks about what time frame should I trade. So what time frame should I trade? One of the reasons newbie forex traders don't do well as they should is because they are usually trading the wrong time frame for their personality. New forex traders will want to get rich quick, so they'll start trading small time frames like 1 minute or 5 minute charts. Then they end up getting frustrated when they trade because the time frame doesn't fit their personality. Some traders are very okay and comfortable with 1 hour charts. Another trader will feel like, oh my goodness, I'm going to burn out before I take a trade. Some traders prefer 10 minutes, some prefer the 5 minutes, some consider the daily, the weekly or monthly chart. So it all boils down to your personality, what you are comfortable trading. Okay, so when we first started trading, Baby Pips is saying we could stick to one time frame. We started with the 15-minute chart, then 5-minute chart, then 1 hour, and then 4 hour. This is the reason why it is natural for all new forex traders until you find your comfort zone, and why we suggest that you demo trade using different time frames to see which fits your personality the best. Okay, so the advice you're getting now from Babypips and from me is that trade with demo accounts and try to see to yourself, convince yourself which time frame is best suitable for your personality. Okay, now let's listen. What time frame is best for trading? What time frame is best for trading? Well, just like everything in life, it all depends on you. But I will actually say it depends on your account and your personality. Some places might prefer the 5-minute chart because it's quicker and they're just getting out of the market. Some places might prefer the daily chart and all that. But let's just go down to see the description that Babypips has given to us. Time frame, description, advantages and disadvantages. Okay, so under the time frame we have long term, short term, and we have intraday. Now the description says for long term traders we usually refer to daily and weekly charts. The weekly charts will establish a longer term perspective and assist in placing entries in the shorter term daily. Trades usually from a few weeks to many months, sometimes years. Now the advantage is this: you don't have to watch the markets intraday. Fewer transactions mean fewer times to pay the spread and more time to think through each trade. Now the disadvantage is this: large swing trades, usually 1 or 2 goods a year, so patience is required. Bigger accounts needed to ride longer term swings, and there's also frequent losing months. Now short-term traders or short-term swing trade. Short-term traders use hourly time frames and hold trades for several hours to a week. More opportunities for trades, less chance of losing moments, less reliance on 1 or 2 trades a year to make money. Now transaction cost, which is the disadvantage now, will be higher. More spreads to pay. Overnight risk becomes a factor. Now what about intraday? Intraday traders use the minute charts, such as 1 minute to 15 minutes, and the trades are held intraday and exited by market close. Okay, so within 24 hours trader will get into the market, take his trades, and then close. So once the market opens, the intraday trader is there, and once the market is closing, before the market closes also, the intraday trader is done. What are the advantages? Lots of trading opportunities available, less chance of losing months or overnight risk. And now we also talk about the disadvantages: that transaction costs will be much more higher because there are more spreads to pay with the number of trades you are taking. Now mentally more difficult due to the need to change biases frequently. Now profits are limited by needing to exit at the end of the day, so you have to consider the amount of capital you have to trade. I said that. And then your personality. So larger time frames require bigger stops, thus a bigger account, so you can handle the market swings without facing a margin call. Now the most important thing to remember is that whatever time frame you choose to trade, it should naturally fit your personality. So think account balance you are going to invest. Okay, think of your personality, what you really want. Do you want to take a trade and sit in front of your computer watching the trade all through the day? That will make you an intraday trader. If you are doing that, it's going to affect your mind, your mentality, your thoughts. It's going to disrupt your emotion, your psychology, and everything, and you're going to have to face decisions every now and then. Should I exit? Should I wait? Should I hold? Should I take? Should I close out? And all that. That is when your psychology starts to have negative impact on your forex trading. Now for short-term swing trade, they are from the hourly, okay, like 1, 2, 3, 4 hours down to weekly charts. Okay, and then from the long-term trader, these are people who look at the daily charts and then the monthly charts. Okay, so which one will suit you? You are the one that is going to do this. Ask yourself very well. The first thing to do is this: ask yourself very well, how much am I willing to fund my account with? 100, 200, 50, 10, 20? Once you know that, then ask yourself, how often do I want to trade? Do I want to sit in front of the computer or no? if you're not going to see the photo of the computer, just know that you have to increase your account balance to suit the kind of trader you want to become. Because if you're not going to see the photo of the computer, which means you're not going to be looking at what is it called now, minute chart, you're going to be looking at the hourly chart. Okay, but you can still have $100 in your account and trade the short-term swing. Okay, this one, post the trade, set your stop loss, set your take profit, let the trade go and go. Stop looking at your computer. Once the trade hits your stop loss, I mean your take profit, you take the trade. Once it hits your stop loss, you are out of the market. There are other opportunities. So let's move to the next lesson. Think about that. Why you should look at multiple time frames when trading forex. Here we are learning from Babypips that it is important for us to look at multiple time frame analysis for our forex trading. So we're going to look at the chart right now and see how Babypips drew up a chart and also put an indicator on the chart. So here's the chart, and it says the moving average you are seeing, simple moving average you are seeing, is that of 200 moving SMA. And from the SMA we are seeing, and the price action is that price is hitting support, resistance here, resistance here, resistance here, and resistance here. Look at this simple beautiful doji, right? And this is a 10-minute chart. Remember, this is a 10-minute chart. So what are we going to do? Seeing this resistance first time, second time resistance, third time resistance, why not? We can short this trade. Okay, so let's short this trade and look at the outcome. Oh damn, resistance failed and price shot up. Why did the price shoot up? Oh my goodness. Let's go find out the answer. Okay, now, so you come down, you saw a sell signal, you sold here, but price rose up on the 10-minute chart. Why did it happen like that? The answer is here. If you had taken your time to look at the 1-hour chart, you will notice that the price of the currency GU has been on an upward trend. It has been trending to the top side. Look at this channel, and it is called ascending channel. So the pair has been trending to the top side. Now you only want to look at the 10 minutes, and you spotted what? A sell signal. What were you looking at? You were looking at the bottom of the market of price here. Okay, you didn't look at the 1-hour chart, because if you had looked at the 1-hour chart, you will see this beautiful doji here, and this trend line, this doji reacting to this trend line, rejecting it. That gives us a clear answer, a clear indication that the price of the currency per GU is going to spike up. Now if you had even looked at the 4-hour chart, okay, you will notice that the price has been in this channel for a very long time, trading to the top side. Okay, this is a very strong indication. And what happened? Look, see how smoothly it became just one candle here, whereas on the other side it was little candles like this, but here it is just one bullish candle. Okay, so it is very important. So I believe you're now beginning to understand why it is important to look at multiple time frames. Okay, because what multiple time frame does is that it helps you to look at the bigger picture. When you look at just one time frame, you don't see the big picture, but when you look at the bigger time frame, you get a better idea of where price has been coming from and where it is headed. So once you have that knowledge and that idea in the back of your mind, you will now scale down to lower time frames and take a position. Okay, so that is all with regards to this session. Okay, they say most beginners look at one time frame, which I have just explained. They grab a single time frame, apply their indicator, and ignore the other time frames. The problem is that new trend coming from another time frame often hurts forex traders who don't look at the bigger picture. So how to use multiple time frame analysis to find better entry and exit positions. So here we are on how to use multiple time frame analysis to find better entry and exit positions. Okay, so here Babypips is telling us that we are going to understand time frame analysis in this place. Okay, they're going to teach us how to lock in one of our preferred trading time zone, zoom in and zoom out of the chart so that we know better what we are actually doing. So are you ready? Are you sure you can hack this? You have basically got a semester left of Babypips School of Pipsology. So do you want to quit now, or no, you want to continue? Well, I think you want to continue as well. So you have to remember, a trend on a longer time frame has had more time to develop, which means that it will take a bigger market move for the pair to change course. Also, support and resistance level are more significant on longer time frames. So the first way to begin is to pick your desired time frame. So let's say you like using the 1 hour or trading on the 1 hour time frame. Babypips is saying once you have picked your preferred time frame, okay, go up on the next higher time frame. So from 1 hour, scale up to 2 or preferably the 4 hours. There you can make a strategic decision to go long or short based on whether the market is ranging or trending. You will then return to your preferred time frame or even lower to make tactical decisions about where to enter and exit, place stop and forget, and profit targets. How do we do this? How to perform multiple time frame analysis? Let's take for example Cinderella. Cinderella has been on a babysitting job for a very long time. She just want to trade forex on the sidelines, okay, to make extra buck. And during her demo trading, Cinderella has come to like the Euro USD pair, and she has been looking at the 1 hour chart because she's comfortable. She thinks that the 15-minute chart is too fast and the 4 hour chart is too long for her. So she just needs, something that is very, very okay for her. So what does Cinderella do? Now, for Cinderella to become successful, she has to first of all determine the overall trend. The same thing you are going to do, okay? I'm changing your name now to Cinderella. Pardon me, whatever your name is. If you are Mr. Mike, Mr. Babypips, or whatever your name is, I'm sorry, changing your name to Cinderella. So assuming you are Cinderella, you will first of all determine the overall trend. And how can you determine the overall trend? By going to a higher time frame. And in this example here, this is the 4 hour chart. So you go to the higher time frame and you look at the chart. Now you have seen the chart. Okay, what is it telling you? Well, you drew a trend line and you say, well, this is clearly in an uptrend. Okay, and now you now know you're in an uptrend. So what do you do next after drawing your trend line? So having determined that you are in an uptrend, you then scale back down to your preferred time frame and you look at the time frame again in the 1 hour chart and you say, oh, it's still bullish. I mean, it's in an uptrend. And more to that, you throw up some indicator, stochastic indicator, and the indicator is telling you that the price of the currency is in the oversold region, okay? And then you say, okay, this begins to make sense. And now you see a doji kind of forming in this area here close to the trend line. And then you can begin to reason to yourself, is it really true? Well, is it really true that this doji we hold, that prices continue to spike, react from this trend line and move back up? You really do not know. And then you decide to move one step further to the downside to be able to get good entry position. So you go to the 15-minute time frame and you take a closer look, and then you see, aha, the price has been reacting to this trend line not once, not twice, not 4 times, okay, and it has been holding. Trend line has been holding. It has not been able to, price has not been able to break the trend line. And you look at your stochastic, it is also in the oversold region, okay, and so you decide to say, okay, fine, I'm going to go in for a buy on this one. And then if you had bought, what happened? Look, voila. But if you didn't buy, you'll be like this man here crying, oh, I missed the trade. Why? Because your analysis was correct. Okay, so if Cinderella had bought in this area here, see what happened to the price. Oh, okay. So you would have made lots and lots of money. Remember, this is not financial advice, okay? So Cinderella would have entered just above 1.2800 and she would have kept that trade open for a couple of weeks and she would have made 400 pips. Remember what they said, she would have kept that trade open for a couple of weeks. I know somebody on Instagram, he takes a trade and let that trade ride for 3 weeks, 5 weeks, If you want me to drop his IG handle, please drop a comment below and I will drop his IG handle so you can follow him. So use at least 2 but not more than 3 time frames in your analysis. Okay, the higher time frames for you to know the direction of the trend, the next lower time frame for you to know where the price is at that particular time, its behavior, and then the last lower time frame for your entries. When you do this, you'll be using time frames, multiple time frames analysis as the professionals do. So now let's move on to the next lesson that says trading with 3 time frames. There are basic rules and principles of trading with 3 time frames, and here at Babypips they are going to teach us right now. Okay, they say we feel that this gives us the most flexibility as we can decipher the long, medium and short-term trends. Okay, so the long term, the medium term and the short-term trends. Okay, so first thing, determine the main trend. The longest time frame we consider our main trend. This shows us the big picture of the pair we want to trade. For example, on the daily chart, Euro USD is trading above the 200 SMA, which tells you that the main trend is up. Determine current market bias. The next time frame down is what we normally look at, and it signals to us the medium term buy or selling bias. Below is a 4-hour chart, and it's clear that EU continues to have a bullish bias, which is very clearly in an uptrend. Now the next thing you want to think about is determine the entry and exit. The smallest time frame shows the short-term trend and helps us find really good entry and exit positions. Remember this picture, right? You missed his trade and was shouting, ah! All right, let's go back. Now the multiple time frame combinations, okay, these uses can help you to position yourself very well as a professional trader. You can use any time frame you like as long as there's enough time difference between them to see a difference in their movement. You might use 1 minute, 5 minutes and 30 minutes. You might use the 5 minutes, 30 minutes and the 4 hour. You might also use the 15 minutes, the 1 hour and the 4 hours, which is my favorite. And then you can also use the 1 hour, 4 hour and the daily. You use the daily to know the trend, you use the 4 hour to know the market bias, and you use the 1 hour for your entries. Okay, and so on and so forth. So just know that here, okay, here the very first one even is for short-term intraday traders. Okay, this also qualifies for almost intraday traders, but here the from 15 minutes to 4 hours qualifies as short-term swing traders. Okay, and then the last one, the second second to the last and the last, they qualify for phenomenal long-term traders, months, weeks and days. So when you are trying to decide how much time in between charts, just make sure there's enough difference for the smaller time frame to move back and forth without every move reflecting in the longer time frame. If the time frames are too close, you won't be able to tell the difference, which would be pretty useless. So now that you have done your class on multiple time frame analysis, okay, add this to your forex trading toolbox. Okay, so multiple time frame analysis helps you to get a bird's eye view, you know, birds fly on the skies, okay, and they see everything. So you use multiple time frame analysis. You have to decide which time frame is best for you. Then this comes from trying different time frames and also knowing the different market environments, and then record your result, then analyze those results to find what works out for you. Okay, so once you have found your preferred time frame, go up to the next higher time frame, then make a strategic decision to go long or short based on the direction of the trend. Then return to your preferred time frame or lower to make tactical decisions about where to enter and exit. Place your stop and profit target. So adding the dimension of time frame analysis to your trading, okay, gives you a better edge over other of the forex traders. Okay, so make it a habit to look at multiple time frames analysis when trading. Make sure to practice. You don't want to get caught up in the heat of trading not knowing where the time frame button is. make sure you know how to shift quickly between them. Practice having a chart that contains multiple time frame analysis. Okay, then do not look at multiple time frames, stick to 2 or 3 maximally, and as your skill continue to increase, you know how to navigate between all the get a bird's eye view on multiple time frame analysis. So let's just take a look at an example. Okay, so let's pick a random pair. Let's use this one. This is US30. Okay, so I see now, or we can see now, that US30, it has been, okay, good. This is a ascending channel. US30 has been in an uptrend. Okay, it has been in an uptrend. Here it is, ascending triangle, ascending channel rather. The type was spotted earlier on. Ascending channel. This is the daily chart. Okay, and then I decide to step down one more time, and it's still trending up. Okay, so I have gotten my confirmation that yes, this is an uptrend. Okay, and then I try to look at structure. This is just what I do. I try to look at structure, higher highs and higher lows. That is what an uptrend does. Okay, so this is a higher high, this is a higher low. Okay, this low is lower than this one, so this is a higher low, and right now it has created a higher high. This high is higher than this previous high. And now what do we learn about retracement? We know that once the price moves to the top side, it will definitely retrace. Okay, it is not a reversal, it will retrace. And where does it retrace to? It will retrace back down to go and test the previous high, which it just broke. And where is the previous high? Here. This is the previous high. So if this level that does not hold, this level here definitely will hold. Okay, so we have now known our long-term bias. It is on an uptrend. So now let's move lower to another time frame, and we can use this one as our entry. So we know that the market is now doing what? It has created a new high and is now retracing. So where will it possibly retrace to? This area here, or this level here. This one will now serve as resistance turns support. But if this support does not hold, this previous support, okay, will definitely hold. So you can short this trade right here, right now. Short it right here, because look at this rejection candles. Okay, 1 2 3, and it's now going to the downside. Okay, so you can short this trade from the 1 hour and let it be, sleep. Okay, and wake up tomorrow and see what happens. Put your stop loss here, stop loss there, entry here, take a shot, and you can take profits here. Okay, and let the trade ride. So this is what we mean by taking, using multiple time frame analysis. And some people use a 15 minutes time frame for entries. So let's just go down to 15 minutes and see. Still downward, the trend is pushing to the downside. Okay, so I hope you understand what we just did. If you don't understand, please watch this video again and make it a practice until you really get a hold on it. Make it a habit. Okay, and remember, multiple time frame analysis helps us to get a bird's eye view. That is how we'll come to the end of course 6 high school. My friends, I can't tell you how excited I am. Personally, in creating these courses, it has been a daunting task for me, but I made a vow to myself that I'm going to complete these courses before I move higher to more advanced courses for forex trading. Okay, so if you like the efforts we are putting in, I am putting in creating these videos, if you are learning something, if there's something you don't understand, maybe you don't understand my voice, you don't understand some words that I say, please feel free to ask or drop a comment below. Okay, I will reply to you as soon as possible. I will respond. Okay, so what I want you to do for me in response and in reciprocation of your appreciation for what we are doing, share this video to your friends. Help somebody else out there who wants to learn something else to make money on the sidelines. Forex is there, the market is opened. Okay, all the knowledge is there, so share it to your friends. And also smash the like button and subscribe if you haven't. And until next time, I wish you success. Good night, my friends.